So let's have a what-if scenario here. If the wine store was making operating losses, what is the most appropriate benchmark to determine overall materiality for the wine store? Would it be revenue? Would it be profit before tax, total assets, or equity? Okay, let's go ahead and broadcast those results. Now, they do always say that the majority rules, and in this instance, the majority have selected revenue. And second in line is profit before tax. Now, let's have a think about that. Firstly, for those of you selected revenue, I'd go with that answer. Remember, you can't calculate materiality on a negative figure. So you can't have negative materiality. So if you were in a loss position, obviously it makes no sense to then use profit before tax because you don't have a profit before tax. Now, it's not a trick question, it's just making sure that you're understanding this concept. So a more appropriate benchmark would be revenue based on the users of the financial statements here being the family members and the bank. Now, a couple of you did ask during our question session a moment ago regarding in the wine store that there was profit before tax was the most appropriate benchmark, and how about would revenue be suffice because it's a non-listed entity? Well, that's well and good, but in this instance, remember we have the family members using the accounts as well as the bank, and remember you need to consider the users as a whole, not individually. So both those parties would be interested in the financial performance of the wine store and their return on investment. So profit before tax would be my selection, but in this what if scenario, we would go with revenue. Terrific. Let's go and work further on your understanding, and I'm going to now give you another what if question. What if the wine store profitability was volatile? What would be the most appropriate benchmark to determine overall materiality if profitability was volatile? Let's have a broadcast of the results, and you wouldn't believe it. We have there must have been just a change in the last minute. Was revenue and total assets were neck and neck. So we've just had a slight change there. Oh, no, they've come back together, neck and neck. So let's start with the fact that it's not appropriate to calculate materiality using profit before tax if profitability is volatile, because it's difficult to determine what the materiality is going to be due to expected fluctuations in that actual result. Once again, looking at the nature of this entity and who the users are of the financial statements, as we said, being the family and the bank, they would be most interested in the financial performance of the wine store and their return on their investment. So I would go with revenue as the one to select on this in this instance. Let's have a think about now your understanding of performance materiality. So the question I have for you is, what impact on poll 4 would an effective control environment have on performance materiality? An effective control environment, its impact on performance materiality. Is it no impact? Is it an increase in risk of material misstatement, and therefore which may increase performance materiality? An increase in risk of material misstatement, therefore may decrease performance materiality, a decrease in risk of material misstatement, and therefore this decreases performance materiality, or a decrease in risk of material misstatement, therefore this may increase performance materiality. Let's broadcast those results, everybody. And the majority is saying it's the last bullet point, and I would definitely agree with that. Remember, an effective control environment will increase confidence in management's oversight and controls. Remember, their controls are their attitudes, actions, awareness with respect to controls across the organisation. This would decrease control risk and therefore decrease your risk of material misstatement. A decrease in risk of material misstatement may result in an increase in performance materiality based on your understanding that there is an inverse relationship between your risk of material misstatements and performance materiality. Great work. Let's go and test your knowledge with another poll, poll 5. What impact would a history of unmodified audit opinions have on performance materiality? I'll give you a moment to answer that multiple choice question. Let's go and broadcast these results. Now, the majority are suggesting that the impact of a history of unmodified opinions on performance materiality would result in a decreased risk of material misstatement and therefore may increase performance materiality. I would definitely agree with what your selection is here. Let's have a think about that for those of you that didn't select that answer. Now, AAA's previous experience over the preparations of the financial statements of the wine store would indicate an increase in their confidence over those financial statements. This confidence decreases the risk of material misstatement, and a decrease may result in an increase in performance materiality. Once again, we're testing your understanding of the inverse relationship between risk and performance materiality. Now, the word that's also operative here, the word may increase performance materiality. So it's trying, the point that you need to remember about this is that it is looking at the auditor's confidence based on their past experience with the client, which can impact their identification and assessment of risk. So let's kick off with another poll, another question for you. Poll 6. We're going to provide you with a procedure which is up on the screen, and it says obtain a copy of the bank statements as at balance date. Send an external confirmation to the respective bank asking to confirm the balances at that date. What type of procedure is this? Is it a test of controls? Is it a substantive analytical procedure? Or is it a test of details? One of those three is correct. Let's broadcast the results. Majority are saying a test of details. That is, well, I wanted to trick you, but it is correct. So it's easy to eliminate a substantive analytical procedure here straight away because there's no testing of relationships between any financial and non-financial information. There was a question before about doing work in the form of a substantive analytical procedure. We will go through a question in a moment of what you need to have in place to be able to do an effective SAP. The other giveaway here is that we're using a confirmation procedure. By nature, a confirmation procedure is trying to substantiate a particular thing. In this case, it's the balance on the bank statement provided to you by the client and whether it's consistent with the number that is in the bank with respect to their records. So, test of details, this one. Let's go and check in on your understanding with procedures again. We'll go into poll 7. So, here's a procedure for you. Of the sample selected, inspect the timesheets of evidence of review and approval by the employee's supervisor in accordance with the store's operating manual. What type of procedure is this? Test of controls, substantive analytical procedure, or a test of details? Let's broadcast those results. This time, the majority believe that this is a test of controls, and I agree with your response. Now, again, we can eliminate the substantive analytical procedure based on what we spoke about a moment ago. It's a little tricky to determine whether this is a test of control or a test of details. Now, the key to identify that the procedure is specific to a particular control activity, which is the review and the approval of a timesheet by a supervisor, and also whether that activity has been performed in accordance with the procedures outlined in the store's operating manual. That means we're focused on how the activity is performed, not its end result, and that's why we're looking at a test of controls. Let's go into poll 8. Now this time there's not a multiple choice question. This is an opportunity for you to type in your response because I'm now going to ask you what are the 4 steps required in performing a substantive analytical procedure. There are 4 steps and I need you to tell me what those 4 steps are. You have an opportunity to answer that. You'll have to type your answers in. Let's see how we go. Terrific, guys. Now remember that a SAP is one that tests the relationship between financial and non-financial information, but generally it provides less assurance than the test of details. let's see what the 4 steps are, and I'm going to ask you to have your red pen to mark out whether you got these. So the first step is to design the SAP. That is to actually define what the SAP is going to do, and in doing so you'll have to identify what is going to be the financial and non-financial data. If we use the activity and that we have in Unit 7, Activity 7.1, this SAP was over payroll expense, and we identified that the data as being the number of employees, the salaries, and any changes to salaries such as the CPI. The second step is to assess whether this data is reliable. Now, if you go to Unit 7, Activity 7.1, we knew we had comfort over these data sources from our controls testing, so we can therefore use this data to develop an expectation. If there are no controls over the data and the data is unreliable, then if we put a cross next to this step, we cannot continue to perform what will become an effective substantive analytical procedure. The third step of the SAP is using our data, we develop an expectation as to what we think the dollar expense should be for the year. We then develop an acceptable variance, which is commonly set as your performance materiality. The last step is then to compare our expected result to the actual amount and see if it exceeds or is less than our acceptable variance. If it's more than the acceptable variance, then the auditor must perform further substantive tests to gain assurance. But if the variance is acceptable, then we don't need to perform any more procedures over this expense or balance. We can conclude and say that it is materially correct and that we have been provided enough evidence to conclude on that basis. So how did you go? There were a number of you that had those 4 steps, and for those of you that didn't, it's time to brush up on substantive analytical procedures in your Unit 7 of the CSG. For the next part of the presentation, we're going to go through some new additional information that I'm going to provide to you. Now, this is in addition to what you already know about the wine store in the background information. So I need you to be conscious of what I'm going to provide you with now, because it's going to influence the next lot of questions. So here's the new information for you. A significant portion of the inventory is imported. The wine store takes ownership when the goods are loaded onto ships. Suppliers send their invoice once the goods have left the supplier warehouse, while the shipping companies forward the shipping documents to the wine store once the goods have been loaded onto the ship. The wine store uses a perpetual inventory system. I'll just give you a moment to digest that information. All right, let's apply our thought process here. So given this new information, it states that a significant proportion of the inventory is imported, and the wine store takes ownership when the goods are loaded onto the ships. So I'm going to ask you a question now. Poll 9. What is the risk and what is the account that's being tested here? I'm just going to pause for a moment, because a lot of you have provided me with the key assertion at risk. Now, the question didn't ask for that. It says, what is the risk and what account is being tested? So the majority have correctly answered that the account being tested here is inventory. By the way, it's not a trick question. It's just making sure that you understand what is actually being tested. The question didn't ask, though, at this point, what is the key assertion at risk? It's asking you to identify what is the actual risk that's actually here. Okay? So there were a few of you that did mention it correctly, and the risk is here that the inventory is not properly recorded when ownership is transferred. So either the inventory is recorded when it shouldn't be, that is, the goods aren't on the ship yet but have been recorded, or the purchases aren't recorded when they should be, that is, that the goods are on the ship but not recorded. So just be very careful about answering the question that's been provided to you, because some of you actually answered what I'm going to now ask you in poll 10. The question here is, now that we've identified what the risk is and that the account balance is inventory, what's the key assertion at risk for this inventory account? It can be only one of those when I talk about the key assertion. Okay, terrific. Let's broadcast these results. Now, I have a theory that the majority rules, but on this occasion, that's not the case. For those of you that answered rights and obligations, you are right on track here. Now, remember that the risk is that inventory is recorded in the accounts when it shouldn't be. Therefore, inventory would be overstated as you don't have a right to that asset. That is, the goods are not on board the ship, and you've incorrectly included this in your inventory account. A few of you did answer occurrence as a key assertion at risk. Remember, the account we're testing is inventory, which is a balance sheet account, and therefore the account balance assertions can only apply here. Occurrence is an assertion that applies to classes of transactions and events and not accounts in the balance sheet. Now, this can be a very easy mistake to make that will cost you marks in the exam, so it's important that the assertion you select comes from the correct category of assertions. For those of you that want some revision on this topic, I'd suggest take a look at Overview Unit 3 video if you need to understand your understanding of assertions, which really is a key auditing concept that you need to be across. Let's move on with this additional information and provide you with some more work around procedures now. So we know what the risk is, we know what the key account is and what key assertions at risk. We're going to have a look at a substantive audit procedure together. And here's an example of a substantive audit procedure that someone has designed in response to the risk that we've identified. The question for you is this procedure appropriate, taking into consideration the risk, the account, and the key assertion at risk? I want you to go and tick yes, or tick, show me a tick if you think this is an appropriate procedure, or a cross if you do not believe it is. Okay, the majority seem to be saying there's crosses. There are a few ticks in there, but there are some crosses. Let's have a look at this, because really I would say the answer would be no, but there are some good things about this procedure, and I will talk to you about that in a moment. So in the procedure, we've actually covered the extent. So the procedure states select a sample. Guys, just be aware that that is acceptable in an exam. If you have not been provided an actual sample size based on risk to actually select the number of items to select, using the terminology to select a sample, and because we haven't been provided that information here either, is acceptable. And while we could improve on how we've addressed the timing in this instance, the procedure states 2 weeks before year end, it's clear enough from the procedure that we should be doing this at year end. Okay, so we've made a reasonable start on the nature. For example, it's clear that we're looking at supplier invoices received just before year end and checking to make sure that they were included as part of the inventory listing at year end. The bigger question is whether or not this procedure actually addresses the risk. In other words, after performing this procedure, would the auditor have obtained evidence about whether purchases are being recorded correctly at the point when ownership is transferred to the wine store? And remember that the point is when the goods are loaded onto the ships. So in this respect, the answer is no. This procedure doesn't address the risk, and this is why. Remember, inventory is an account balance, which means we're looking at what's recorded as of year end. Now, since the shipping terms are free on board, ownership transfers once goods are loaded. So anything that's on the ship before year end should be recorded in inventory, while anything that hasn't been loaded until after year end should not be recorded. Now, unfortunately, the supplier invoices won't tell you when the goods have been loaded, because in the additional information it said that the suppliers send an invoice once the goods have left the supplier warehouse. The only audit evidence we have in this information is from the shipping company, and that means we should be looking at the shipping documents which are provided when the goods are loaded onto the ship. Now, for those of you that would like to have a refresher on how to write a robust audit procedure, taking into consideration what is the risk, what is the account at risk, what is the key assertion at risk, and then developing a procedure that addresses that based on, as well as considering the nature, timing and extent to be a robust procedure. There is a new video available to you in Unit 7 that you may wish to spend 10 minutes to have a look at to assist you with designing audit procedures and taking into consideration what we've just talked through. So we've now said that this is not good or not a robust procedure. So let's have a look at a revised procedure and how this would look. And the key differences are in bold. So notice that this version of the procedure focuses on inventory shipments and shipping dates, which is the point when ownership is transferred to the wine store. The window of testing around year-end is also expanded to include more transactions, especially transactions after year-end. And finally, the procedure also focuses on inspecting shipping documents, which is more relevant to the risk than supplier invoices, and is more precise in describing what should and should not be recorded as part of inventory at year-end. So we've gone through a lot today, and I want to now reflect on what we've covered and some key exam tips that I'd like you to take into consideration as you continue to work through the module and get ready for your exams. So the first point is read the required. Pay attention to the task words and the keywords in the required. You only get marks for answering the required, nothing else. If the required is explain, don't stop at identify. If you just need to identify, don't waste time justifying. If you're asked for 3 audit procedures and only give 3 audit procedures. There's no bonus marks for writing extra procedures because they won't be marked. In real life, your manager and your clients don't want to hear about generic solutions. They want solutions specific to their problems. The CA program is preparing you to be a professional, so the exam is no different. We're expecting that your answers are going to be specific based on the scenario and the background information that's provided to you. Generic responses do not get marks. Be specific in your procedures and make sure you've covered all the bases of nature, timing and extent. Don't just instruct someone to go and get supporting documents. That could mean anything. Did you mean supplier invoices? Did you mean shipping documents? So you need to be specific when you are designing an audit procedure. That could make a difference in whether or not your procedure addresses the risk. And we often say that we like you to we test the procedure by looking at the remote island test. That is, if someone was on a remote island, they couldn't be in contact with you. They had to know exactly what they had to do based on what you've written to them. When you're looking at risks, make sure you always start with the risk when you're designing a procedure. If you're not clear on what the risk is, you can't respond to it effectively. So if the risk is around the classification of current and non-current interest-bearing liabilities, your procedure needs to address that risk. Writing down some amazing procedure that addresses completeness of interest-bearing liabilities is going to give you no marks. So be very, very careful and understanding what that risk is. Again, if you go into the Unit 7 Designing Audit Procedures video, you will get an opportunity to work through and practice on that. Everyone obviously has a different approach to studying and preparing for an exam. This means everyone's critical file will look different. Remember, auditing is a mindset and being able to provide your professional judgment and professional skepticism, and it's an applied discipline. The other thing is to remember is you don't bring your critical file to the exam room until you've used it practicing doing questions. Don't memorize standards. You have to really understand that they are a set of principles and actually how to apply them to different situations, and you have numerous opportunities to do that via the teaching you through the process through the worked examples and applying it through your activities. And then coming closer to the exam, we will give you an exam preparation paper, as well as you will have access, as you already know, to previous exams. Okay, and when you get into the exam room, you'll find that time passes very quickly. So keep this in mind when you're preparing your critical file. You have to be able to find what you need almost instantaneously. So make sure that you are organising the critical file and you are actually utilising it as you are doing your work.